I'm trying to find that.
Well, welcome everybody. This is our last ring speaker of the year. Last Thursday, Scott, we had a ring speaker scheduled for Thursday, but with the hurricane pending, threatening, they canceled classes, including online classes, which was kind of interesting. But our speaker today is Scott Frame. Scott is a vice president in the banking finance group at the Federal Reserve Bank of Dallas. Prior to that, he was a senior economist at the Atlanta Fed. And actually, prior to that, he was a senior financial economist at the U.S. Treasury Department for a number of years back in the late 1990s. He also, interestingly, spent several years as the Delk Distinguished Professor of Finance at the University of North Carolina at Charlotte. So spent a few years, I guess, being a full-time academic. Although he's not a full-time academic, he's published widely in some of the major journals. He received both his master's and his doctorate degree in economics from the University of Georgia. So he and Bill Hughes were doing the secret handshake here a few minutes ago. But I think, as by way of introduction, we have a lot of obviously high-level commercial real estate folks that join us as ring speakers. Obviously, these are folks that are experts in development. They're experts in various aspects of commercial real estate. But commercial real estate doesn't happen in a vacuum, right? Public policy really affects real estate. And of course, we spent some time thinking about how land use regulations and zoning kind of local public policies affect real estate. But part of the reason we're interested in having Dr. Frame join us today is, in addition to being sort of a commercial real estate expert and a housing expert, he's also worked a lot, continues to work on the policy side. So what happens on the policy side is going to always have an effect on real estate going forward. I just spent a few hours ago on a NAREIT conference call. A lot of the discussion there was about how the Biden administration and its proposed policies might affect commercial real estate going forward. So anyway, public policy is a big issue, and Dr. Frame's an expert, not just on institutions and credit markets, but on sort of how public policy relates to housing and to real estate. So with that introduction, Scott, please, the floor is yours.
Okay, thanks, David, for the kind introduction, and very much appreciate you and the others down there at the University of Florida inviting me to speak today. As David mentioned, we're going to focus today principally on the residential mortgage market and specifically on the single family market, although I will have some things to say about multifamily finance. And we're going to talk about two institutions that are really central to the residential mortgage market in the United States, and those are Fannie Mae and Freddie Mac. I'm sure that you all are passingly familiar with these financial institutions in what their functions are and the fact that they got into trouble during the financial crisis. And so today I'm just going to provide a little bit of a deeper dive into helping you understand their business and what happened to them during the housing and financial crisis, and ultimately what's been happening since. And there was actually a big announcement in this space yesterday. Now, one thing David doesn't know, perhaps, is that I started my career at the Treasury, as he mentioned, and one of my jobs there, the Treasury Department back during the Clinton administration became increasingly concerned about the rapid growth at Fannie and Freddie. We'll discuss that soon. And after I left to join the Federal Reserve, I found the issues surrounding these types of entities that academics hadn't really followed them that closely. And so I sort of set out to write a lot of what we would sort of, academics would describe as sort of descriptive papers, but trying to lay out a whole or frame a whole set of issues for academics to begin to explore and to understand about sort of the costs and benefits of large-scale government involvement in our residential real estate area. Oddly enough, as the financial crisis occurred, this is the part David may not know, but in 2008, I was called to back to the Treasury Department, and I spent the fall of that year working on the federal takeover of these two companies. And then, of course, while I was there, my colleagues that I was working with were also busy with many of the other rescues and failures that were happening. Things like AIG Group, Lehman Brothers, and the like. So it was a fascinating time, even if I was just sort of a worker bee. It was an unfortunate and scary time, I think, for our society, but it was also fascinating and quite a learning experience for me. So with all that said, you have a little better feel for where I'm coming at. And so we'll take you on a little tour of Fannie and Freddie today. Okay, so Fannie and Freddie are what we call government-sponsored enterprises. And so I use this sort of shorthand, this acronym GSEs for them. And they play a central role in the U.S. housing finance system. So right now, to give you a sense, the residential mortgage market in this country is a $13 trillion market. And they manage the risk on almost half of that. So these are enormous financial institutions that are focused in a specific part of capital markets. Now, Fannie and Freddie are publicly held institutions. They actually have publicly traded stock, for example, but they were each individually created by acts of Congress to fulfill public missions. And in their case, we have two of these more by historical happenstance, but their charters are quite similar. And the Congress has directed them to enhance the liquidity and the stability of the U.S. secondary mortgage market, and thereby to promote access to mortgage credit, especially among low and moderate income households and neighborhoods. And as I mentioned at the outset, they're active in both the single family and multifamily markets, although the split on that's about 90%, 10% in terms of dollar exposures. So each of these companies have these charters. They were each created by the Congress, but these charters convey upon them important competitive advantages that altogether, plus some past government actions around these institutions and others like them, have long led market participants to view their financial obligations as implicitly backed by the government. Congress specifically sets them up in the way I'll describe here in a minute in order to, you can think of it as Congress's way of trying to set up a federal program, but without having to pay for it. So they're basically able to keep them off the government balance sheet through their structure. Now, Fannie and Freddie over the years leveraged these competitive advantages from their charters to become very large, very profitable, at least before the financial crisis, and as I can attest offline, very politically powerful. These were amongst, before the financial crisis, probably the two most fearsome political entities on Capitol Hill. Okay, now both GSEs, as I sort of alluded to, were declared insolvent in September of 2008 and placed into what's known as federal conservatorship. They ultimately received almost $200 billion in taxpayer funds to remain open and serve the housing market during the depths of the housing crisis. I realize a lot of the folks today, were younger You were in, probably in middle school during that time. But there was quite a housing cycle that occurred in the United States during the 2000s, and a bust that lasted really from 2007 through 2011. It was a pretty dark time. Now, Fannie and Freddie were long viewed by the public and politicians alike as sort of shining examples of public-private partnerships. The idea of harnessing private capital to advance a social goal, in this case, expanding home ownership. But the reality was that their hybrid structures, this public-private structure, was really destined to fail because of their singular exposure to residential real estate and moral hazard incentives that arose from having public guarantees. So you'll hear some critics of these two firms refer to it as the heads I win, tails you lose situation. The structural problems with Fannie and Freddie were understood by many, but serious reform efforts were portrayed as attacks on the American dream and hence politically unpalatable. And remarkably, this view persists today after all we've been through. So the GSEs I mentioned have these congressional charters, and they include a number of institutional benefits that are designed to reduce their operating and funding costs. So each of them maintains a line of credit with the Treasury. Their mortgage-backed securities and debt securities are considered to be quote unquote government securities for purposes of the Securities and Exchange Act, which in effect means that they're exempt from any sort of registration requirements. Their securities can be used for public deposits. The Federal Reserve can and does today buy their securities in large quantity, actually, as part of its open market operations. And commercial banks and other depository institutions, for example, are permitted to hold Fannie and Freddie obligations without limitation. Their MBS and debt are actually issued and transferred through the Federal Reserve's book entry system, which is the same platform used by the Treasury. So, some of these things, are cost saving features. A lot of them are just signals to the marketplace that these really are part of the government. They're also exempt from income taxes as well. So I talked about this perception of a taxpayer backstop, and clearly, as we saw the events of 2008, that was indeed the case. Because of the taxpayer backstop, Fannie and Freddie are regulated. They're actually subject to a two-part regulatory system that's run by an entity known as the Federal Housing Finance Agency, or the FHFA. And this two-part structure is really, one part of it is about their mission. As I said, they have a public purpose about, providing liquidity and stability to the mortgage market, and especially trying to assist with home finance for low and moderate income households and areas. And so they have a regulatory area that focuses on whether these two GSEs are achieving their missions. An example of that are they're subject to percent of business housing goals, for example. The part that I've focused more my attention on over the years has to do with their safety and soundness regulation. So these would be things like capital requirements. So basically, they're regulated in a similar fashion to the way the government regulates banks, for example. So as I alluded to before, they have both single family and multifamily businesses. So in the on the single family side, the GSEs are restricted to dealing in what are known as conforming mortgages. So those of you that have bought a home in the past and borrowed for that, you've probably heard of this term, conforming mortgage or the conforming loan limit. So that's what this means. There are these loan size limits. Fannie and Freddie, and those loan size limits today are just over $500,000. Fannie and Freddie are also prohibited from lending directly to households. And the mortgages that they acquire must have at least a 20% down payment or an equivalent credit enhancement. And that would be like private mortgage insurance. So Fannie and Freddie have two core business lines. And the first is what they refer to as their credit guarantee business. And this is basically where they're going to purchase mortgages from lenders, and they're going to buy a pool of loans, and then they're going to issue mortgage-backed securities backed by those loan pools. And what Fannie and Freddie do in this instance is they're effectively like an insurance company. They're going to guarantee the timely payment of principal and interest on these securities. And in exchange, the security holder is paying a guarantee fee, which again, you can think of as like an insurance premium. Their second business is portfolio investment in loans and securities. So here they purchase and hold financial assets on their own balance sheets. These are principally going to be whole loans as well as mortgage-backed securities. Often they're their own, they would make markets in their own mortgage-backed securities. At other times, like during the mid-2000s, they also bought a lot of privately issued mortgage-backed securities, and I'll come back to that in a moment. Now, mortgage-backed securities, owing to prepayment options that U.S. mortgages have embedded in them, they have to basically hedge a lot of interest rate risk, and then they're going to use different types of derivatives like interest rate swaps to manage that. So this will give you just sort of a simple schematic here of, for example, I stole this from the Fannie Mae website, and this is going to be what they would refer to as a swap. And so basically, at the bottom here, you have a borrower and a lender that are interacting. The borrower takes out a mortgage, receives cash. So the lender basically then interacts with Fannie Mae and says, here, I'm going to give you a set of these mortgages, and in exchange, you're going to give me a mortgage-backed security that basically is backed by these same mortgages. And in exchange, there'll be this guarantee fee that I'm paying for. And then the lender will then either hold that security on their own balance sheet. Here, this lender, you could think about it as being a commercial bank. Or they may sell that security into the bond market, and there are all sorts of investors that hold large portfolios of these. So this give you a little bit of a sense of the total exposure and the market shares of Fannie and Freddie together since 1990. You can see in 1990, they basically were managing the risk on probably about $800 billion in mortgages. But by the height of the crisis here, they were up over 5 trillion. Their market share grew over time here during the 90s. And then they had a hiccup here that I'll talk a little bit about. Um, this period here in 2002 and 2003, both of them were embroiled in accounting scandals. So there was, right before this time, there was a famous accounting scandal at Enron. And so there were an awful lot of people looking around trying to understand how different types of financial firms um, were reporting their hedge accounting relationships. It turns out Fannie and Freddie weren't doing so well with that, and they got hit with some penalties, including some capital surcharges. This period here, this dip during the mid 2000s, represents the period when private label, when there was a housing boom in the United States, and there was a lot of subprime lending and a lot of low documentation lending, and so there was a substitution of mortgages into private markets and away from government. We get the going into the crisis period, those private markets break down, so people migrate back to Fannie and Freddie. Now, on the multifamily side, um, so the multifamily businesses had been of modest size when I first got involved with following these firms, but have grown over time, and especially actually over the last decade as we saw a big boom in multifamily construction. Um, so Fannie and Freddie, their typical loans, they offer a variety of terms, but their standard loan is going to be a 10-year fixed rate loan with a balloon payment and a prepayment penalty. So you guys, some of you certainly might know better than me, but I think of this as being, pretty similar to the types of loans that we see in commercial mortgage-backed securities deals. Now, each of these loans feature a risk-sharing relationship between the lender and the GSE, either Fannie or Freddie. Now, Fannie's program is referred to as Delegated Underwriting and Servicing. Now, their structure is a pass-through structure, kind of similar to what I described for single family. There's a loan, there's a wrap, and then the security can then be sold to investors. So my understanding is that on the front end, or for the first losses that might occur in the event of a default, they have either pro rata loss sharing, or there's some pre-specified formula, and so for those initial losses, Fannie or Freddie, Fannie in this case is going to be responsible for absorbing some, and the lender, like a commercial bank, would be responsible for absorbing the others. Now, what's interesting here is that a lot of these Fannie deals are backed only by single properties. So this creates basically almost like loan liquidity. But these are going to tend to be much smaller, and you're not going to have obviously any diversification in those deals. Freddie's program is a little different. These are referred to as K deals. Now, these are going to be structured deals where you're going to have, and I have a schematic here a little bit later, but you'll have a senior bond, and then subordinate bonds underneath it that provide credit support. And so in the K deals, Freddie Mac is basically fully guaranteeing the senior bond and basically effectively creating a AAA bond there. But the subordinate bonds don't have any guarantee. So that's the way in which they share risk with the lenders. So the lenders will then either maintain or hold on to those subordinated bonds, or they may have outside markets for some of those, but those are going to be a lot riskier. They, as part of those structures, they'll do either pro rata or sequential waterfalls. Um, these K deals are generally backed by pools of loans, so they're going to, in that sense, they're going to feel a little bit more like a structured mortgage-backed security. And that's it. And as I mentioned earlier, this multifamily business is about 1/10 the size of the single-family business. And again, like the single family business, Fannie and Freddie both engage in providing these credit guarantees for the securities, but they also hold some whole multifamily loans on their own balance sheets and also buy commercial mortgage-backed securities backed by multifamily properties that may be publicly issued as well. I'm going to show you a couple more things here, and then we'll take a little breath. So this will give you a sense of the GSE's multifamily business since 1990. So this is in dollars. You can see it was de minimis in the 90s, and then began to take off in the 2000s, and has really ramped up since 2013. Their share of the market had steadily climbed and then receded some there. And so if I put those two together, I can look at their total exposure in both residential and commercial real estate and the overall market shares. And so you see a trend that because the single family dominates their business, the trends are a little smoother, but they generally mimic those that we see in the single family. So again, in 1992 here, there's a law passed in the 1980s. David and Wayne will remember this as well, but there was a savings and loan crisis in the United States. And coming out of that, Fannie and Freddie also had some difficulties during that time. And so in 1992, Congress, for the first time, actually regulates Fannie and Freddie. But one of the things that they do is they the Congress puts capital requirements right directly into the law, which provided some certainty for them, and these capital requirements were set substantially lower than those for banks, and so it really had the effect of charging their business. And so as a result of that, from that period from say like 93 to 2002, sort of their golden age, it was rapid and profitable growth achieved through some combination of mortgage market growth. Also senior management strategy changed. A lot of the folks that worked at these companies back in the 80s had a mindset, more of a public sector sort of mindset, and received more like public sector compensation. Well, once, as publicly traded companies, and they started to feel the pressure of earnings, they had some clear advantages now. During this time, they learned to really exploit the advantages embedded in their charters. And they became much more efficient operations. As I mentioned here, in 2002, we see we had the accounting scandals and the capital surcharges. During the 90s, I would also add that, as somebody who always has like one hand into following the politics around these companies, these two companies were very close, had very close ties with senior officials in the Clinton administration. But they faced in 2002, after the election of George Bush, they faced I guess that was in 2000, excuse me. But through the Bush administration and the Bush years, they faced a much chillier reception. This again is that private label boom, and then ultimately in 2008, about right here, the two companies ultimately fail, and that's what I'm going to talk about next. But in the meantime, I wanted to stop and maybe take a couple, three questions people have.
I had a question about the conservatorship. I was wondering if the plan was to eventually get them out of conservatorship, and if that's the case, how does that look? What would, I guess, the mortgage markets look like if that does happen?
That is a terrific question, Jason. I'm actually going to talk about that towards the end of the talk, because there actually is movement continuing even post-election towards that outcome, but it's very uncertain what's going to happen. But if you bear with me, I'll talk about it in a little while. Wow, tough crowd, David.
Nothing in the chat.
Okay, thank you for checking that. Okay, so to this point, we've sort of talked a little bit about the background. Now we're going to pivot. We're going to talk about the housing crisis generally, and then more specifically as to the business at Fannie and Freddie, and then we'll come back to what happens after the crisis and what's going on today to kind of get at Jason's question. Yep. Okay. So housing and mortgage markets become increasingly stressed in 2007 and 2008 as a result of house price declines and a weakening economy. So house prices had boomed substantially over the 2002 through 2006 period. But then in the first quarter of 2007, we start to see the beginnings of some stress. House prices in that quarter actually fell for the first time, albeit only a modest amount. And there were actually a number of subprime mortgage lenders that went bankrupt that quarter. Now, the reasons ultimately for this crisis are going to be, we had this housing bubble. We're going to see substantial house price declines. Construction activity stops. The economy weakens. A key part of this is that, and we didn't honestly have a full appreciation for how severe this was, but borrowers, there was a large share of borrowers that had an awful lot of leverage on their homes. During that mid-2000s boom, we saw a lot of borrowers being able to, they had property appreciation. They were able to then go to lenders and effectively cash out that equity through cash out refinancing programs and put on a new loan, oftentimes at 100% loan to value. And so you had a large number of borrowers like this, and then all of a sudden you have price declines, and this results in a situation of negative equity or the borrowers being underwater. So, as David and Wayne can attest, the theory of mortgage default sort of posits that negative equity is sort of this necessary condition for default. If you had positive equity in your home and you face, a job loss or some other sort of income shock, you can always sell the house and you'll still be positive. But if you're underwater and then you have something happen with your income situation, you're just not going to be very inclined to keep the payments up or even try to. So what ends up happening is we have this wave of mortgage defaults and foreclosures. Florida, of course, I don't have to tell many of you, was hit especially hard. So as I was saying, these price declines, these defaults are starting to emerge during the first quarter, tick up during the second quarter of 07. And then around the 1st of August, we have the tremors of the first set of tremors about the global financial crisis. We start to see, hedge funds blowing up and banks having to take a lot of special purpose entities or sort of affiliate firms that they'd created and having to bring them back on their balance sheets because a lot of the riskiest loans, which were financed in private through private securitization, were going bad. Let's see. So, and this included even the AAA securities. So there were an awful lot of privately created and issued mortgage-backed securities during that 2002 to 2006 period. And they tended to be backed by subprime mortgages, or what in the industry were known as Alt-A mortgages, which you can think of as people with better credit than subprime, but they were low documentation loans, and they performed especially bad. Now, one of the problems is that, as it turns out, the two largest holders of these private label mortgage securities were Fannie and Freddie. And so in 2007 Q3, they report some losses on their securities holdings. Now, what happens next is kind of interesting, which is, so you have this housing market stress. There'd been this big buildup in the private marketplace. It begins to collapse, and Congress, working with the administration, suggests, well, maybe Fannie and Freddie can help. And so you recall I spoke about those accounting scandals back in 2002 and 2003, and one of the punishments for that were surcharges on their capital requirements. So as part of the trying to help here, the regulator actually lowers their capital requirements during the fall of 2007. And Congress passes a bill that increases those conforming loan limits. And so that allows Fannie and Freddie to be able to deal in loans of much larger sizes, especially for higher cost areas. And in fact, from August 07 until August 08, the GSE their combined exposure swells over $600 billion. So we have the makings of a crisis in financial tremors. People think it might be contained. We figure, okay, the government can help provide liquidity by loosening the reins on Fannie and Freddie. Okay, this gives you a sort of a sense of home prices and negative equity. So Frank Notaft at Freddie Mac, or he's now at CoreLogic, pardon me, but he was kind enough to give me this series on negative equity. So this, unfortunately, they only started it in 2009. But this blue line, looking at the axis over here on the right-hand side, this is the fraction of mortgages in the United States, residential mortgages, where borrowers owed more than the value of the property. And so you can see that's, hovering around 25%. So 1 in 4 people, or 1 in 4 households with mortgages, were underwater at that time. And this persists for a couple of years. Now, over time, this has come down. Some of that was due to, people defaulting and their mortgages going away, but a lot of it was due to house price growth. And so this red line here provides a home price series from the FHFA going back to 2000s. So you can see the big run up in home prices here during that housing boom. Then we have the housing bust. And then since 2011, 2012, we've been on a very steady positive trajectory. So we're into now the summer of passing through the end of 2007 and 2008. And so this chart here presents Fannie Mae and Freddie Mac, their stock prices from July of 2007 to December 2008. And so you can see, as I mentioned, in Q3 07, they report a loss for the first time, and their share prices fall from the 60s down into the high 20s. Sort of hovers around there. And then in March of 2008, we have the failure of Bear Stearns. This is sort of the next tremor preceding the financial crisis. And you can see there again, starting to drift down again. There's a rescue. JP Morgan buys Bear Stearns. People calm down a little bit. But then through the summer, people become increasingly concerned about Fannie and Freddie. And that's what I'm going to talk about next. So as we get into the summer of 2008, and equity holders in the two companies become increasingly concerned about whether Fannie and Freddie have sufficient capital. They started to post losses. People are coming around to the idea that we're in for a big housing correction and looking forward and saying, gosh, if house prices keep going down another 10, 15, 20%, what are default rates and loss rates going to look like? And so, as you guys know from your class, you're always trying to project out cash flows and discount them back. And, I think people were seeing a lot of losses as they projected out. More importantly, for financial stability, holders of mortgage-backed securities and debt securities issued by Fannie and Freddie, they really want clarity from the United States government about whether or not they're going to be made whole. So we've all gone along with this game of an implicit guarantee, but people are starting to ring up people in Washington and saying, we need this taken care of. Famously, during that time, there was the Olympics were in Beijing, and the Treasury Secretary, Hank Paulson, was over for the Olympics. And he writes about this in his book about the financial crisis, because the Central Bank of China it held something like $300 billion of these mortgage-backed securities and another $300 billion of debt of Fannie and Freddie. And the Chinese sat him down and explained to him about how he was going to go back to Washington and take care of this problem for them, or there was going to be, or we were going to have problems. So what happens? So Mr. Paulson returns from China, and in July of 2008, Congress passes the Housing and Economic Recovery Act. And there were two major provisions there. One was the creation of this new federal regulatory agency, the Federal Housing Finance Agency. Really, it was just taking parts of other regulatory agencies within government and mashing them together. It also gave this new agency much stronger supervisory and regulatory powers, really to put it on similar footing to bank regulators. It provided authority to the Treasury to make unlimited debt and or equity investments in Fannie and Freddie through the end of 2009, and what Hank Paulson, secretary at the time, referred to as his bazooka. So the Treasury had unlimited investment authority, and shortly thereafter, the Treasury, the Federal Reserve, and Morgan Stanley, who was hired to assist, began a comprehensive review of both companies. And, you know, a little sidebar here is this actually was the test case for what later became the stress test for banks and the stress test program that we have today for setting capital requirements for banks. The first one was actually a stress test done on Fannie and Freddie during this time to really try to get a handle on how bad the losses could be. So the GSEs report their second quarter 08 earnings in early August. These are not good. The companies are still technically solvent on a book value basis, but really insolvent on a market value basis if you begin to look through the statements. Freddie had very large losses on privately issued mortgage-backed securities. They held a very large amount of subprime mortgage securities. Fannie had a lot, but proportionally much less so. But they had taken a lot more risk in their guarantee business. So ultimately, what happens? That's sort of in early August. In late August, market conditions begin to deteriorate rapidly. And there becomes really an urgency for the government to act. And I think there was concern at the time that a disorderly failure could destabilize markets, given the size of the market at that time. It was around $5 trillion of risk that the GSEs were managing. The concentrated holdings of their exposures, including those in China, the use of their securities as collateral in repo transactions, short-term funding markets, and also these were the two 800-pound gorillas in interest rate derivatives markets as well. And so really, you know, a disorderly failure was just it was just going to be intolerable. And we had at that point the authority for the funding to go ahead and take over the companies. So in early September of 2008, Fannie and Freddie are put into federal conservatorship. The Federal Housing Finance Agency is the conservator. And in that capacity, they assume the responsibilities of directors, officers, and shareholders. And the aim of such things are really to conserve assets and rehabilitate firms. And so as we'll come back to now, as Jason was alluding to earlier, that you know we're a little past the housing bust now. So why haven't they been rehabilitated and sent back out into the public? So the FHFA is named conservator, and then a key part here is the Treasury enters into what's known as preferred stock purchase agreements with each GSE in order to ensure they maintain positive net worth. So if you think of a very simple capital stack, and let's put the mortgage-backed securities aside for a moment, but you're going to have a lot of the Fannie and Freddie had a lot of senior debt. They had a little bit of subordinated debt. They had a little bit of preferred equity, and a little bit of common equity. So what the government wanted to do as best they could was they needed to protect the senior bondholders, but they didn't want to protect the equity holders. So what happens is they enter the capital structure, the government enters the capital structure in between. And so their senior preferred shares are senior to the existing preferred stock, but junior to the debt claims. Okay, so these agreements originally were set up to be for $100 billion per GSE, and there was to be a 10% dividend. Ultimately, there were 2 or 3 amendments over time to these agreements, given the scale of the losses and the length of time over which these were being realized. And so later, the last amendment, the lines of credit are $200 billion per GSE, and they sort of did away with the 10% dividend and went to what's known as the net income sweep. So any profit and loss each quarter just goes to the Treasury. So if they make money in a given quarter, the money goes to Treasury. If they lose money in a quarter, Treasury loses that money. Now, in exchange, what do taxpayers get from this? They get $1 billion in these preferred shares straight away. Warrants to purchase up to 79.9% of common stock at something like 1/1,000,000th of a penny per share. A quarterly commitment fee, and an agreement that Fannie and Freddie are going to shrink their investment portfolio businesses, which were seen as not central to the mission, and at that time had become very large, and people had been concerned about systemic risk. So this was quite a dramatic time, but once the existing management was removed and new management teams were brought in and the companies were reoriented, Fannie and Freddie did a lot of work to assist with the housing market recovery. They worked closely with the government on a program known as the Home Affordable Modification Program, where they did a lot of loan modifications for people who were struggling to make payments. They did large-scale refinance programs. And so the infrastructure and the expertise at these companies was very valuable, and certainly helped with the healing process as long as that was. And then over time, once the market stabilizes, we begin to see some changes to their operations and their business practices. There were big investments, for example, in the IT infrastructures. And then, a couple of business practices that changed that you might be interested in are, for the first time, they introduced risk-based pricing of their guarantees. And they also start issuing what are known as credit risk transfer securities into public markets, where they begin to de-risk themselves. So originally, for example, with the guarantees during the housing boom, the average guarantee fee was 20 to 25 basis points per year. And there were volume-based discounts. So as long as a loan met a broad set of standards, it faced a unit price, although that unit price might be different across lenders. Wells Fargo and Countrywide Mortgage got the best prices. Your local community banks and credit unions got the worst prices. So in the post, pardon me, in the post-crisis period, there's a move to a much higher base guarantee fee averages about 60 basis points. And then there are add-ons depending on loan risk. And I can show you here, this is what's known as the loan level pricing adjustments. And what you can see here is so each, when a lender is going to deliver a mortgage to Fannie Mae, for example, the guarantee or a group of mortgages, let's say they're all the same, they're going to face a guarantee fee of about 60 basis points per annum. Plus, for each loan, we have to look through, and there may be surcharges depending on the risk. So we can see here, here are some credit score ranges on the left-hand side and loan to value ratios across the top. And so if a borrower on a loan has a credit score above 740, yeah, go ahead.
We can't see your
Oh, I'm sorry. You can't see the cursor.
right.
Oh, I'm sorry.
I think you moved to another diagram that we're not seeing.
Oh, what are you seeing?
Post conservatorship slide.
Oh, really? Oh, hold it. Are you seeing the Dallas Fed slides here? Oh man, I wonder if you were seeing the wrong set of slides all along.
No,
We were with you until just a moment ago.
I think we're okay till just recently.
Can you see anything right now?
A window with rays of light.
Your background.
Oh man, how's that? Can you see that?
Yes.
You can. Okay, so I must have been, so maybe I had the other set of slides up. Pardon me. Can you see that now? Are they matrices?
Yes.
Okay, pardon me. So what you can see here in the top left here, so if you have a credit score over 740 and a loan to value ratio under 60, there's no additional charge. If you have a credit score over 740, but your loan to value is between 90 and 95, you have to pay 25 basis points of the loan amount up front to deliver that. If you had that same loan, but the borrower's credit was say 630, you'd actually have to pay 325 basis points. So the way this works out, the borrowers, from the consumer's perspective, we don't really see this directly in that nobody is charging us this big loan amount in order to originate the loan. But what the lenders do is they have a way of converting these upfront charges into ongoing fees. And so it'll just be sort of baked into the interest rate. And so the main pricing is along the credit score and LTV dimensions, but you also have additional fees related to adjustable rate mortgages, mortgages secured by manufactured homes, second homes, or investment properties. So you can see here with investment properties, the surcharges are very high, and probably outside of the actual level of risk, especially for some of these lower LTV loans. But I think that the government has tried to discourage Fannie and Freddie from being in that business. Okay. So another big change, as I mentioned, were the GSE's credit risk transfer programs. And these are programs by which, basically the government found itself, owning these companies. There's no private capital there. And so there's a lot of open-ended taxpayer exposure. And so what they want to do is move some of the risk off into private markets. And so they begin these programs. There are 4 different broad types of programs, but the most common are these structured debt issues, which are basically synthetic notes, similar to credit default swaps. And so Fannie does this through what's known as their Connecticut Avenue Securities. Freddie has a name for these called Structured Agency Credit Risk, or STACR. And so basically what these are is they sell a security to invest, or an investor agrees to take on a certain risk, and they're paid an ongoing fee for insuring that risk. Excuse me, but then losses are absorbed, or the fees are reduced in order to, and that's the way the losses are passed through. So to date, the reference pool, they've transferred the risk associated with about $2.4 trillion in mortgages. It's amounted to about $72 billion in actual risk in force. And these programs have accounted for almost 3/4. The differences here sort of relate to whether they're, sort of cash securities or synthetic, and what part of the capital stack is being insured. And this will give you an example of a deal here where we have, this is sort of a structured debt issuance. You have a first loss position here. Oftentimes, Fannie or Freddie will simply hold on to this, but other times they've done some risk sharing with the lenders. So they might, the lender might hold a part, and Fannie and Freddie might hold a part. And then these M tranches, M1 and M2, are what they sort of refer to as mezzanine risk. And sort of the analog here for Fannie and Freddie is this type of risk really, in a lot of ways, substitutes for capital. And so they'll retain some of the risk and sell it off. And then this senior tranche, which represents, this is a very low probability event. But you can think about this as basically holding the tail risk, or that of really, really bad outcomes, and Fannie and Freddie will retain that. And the principle is that when you have these very infrequent but severe occurrences, that maybe the federal government is probably best positioned to take those types of risks. Okay, I guess I kind of messed up my other slides here. What did I do with those other ones? You still see the slide with the Dallas Fed moniker on the bottom?
Yes.
Okay, I guess I had them backward all along. Okay, so the last thing I want to talk about is this prospect for recapitalizing and releasing Fannie and Freddie. So, going back to probably like 2012, or actually in the wake of the financial crisis, and I guess in 2010 we have the Dodd-Frank Act, which is a very comprehensive piece of legislation, deals with a lot of the issues, real and perceived, in the financial system. But the one area that largely goes untouched is the mortgage market. And of course, the irony of that is that it's really was where everything started. And the reason is that the housing is just so bundled up with politics, and so these legislative reforms for housing finance have really been elusive. But there is some political consensus that seems to exist that the reformed GSEs or whatever were to replace them would operate with more capital, an explicit and priced full faith and credit guarantee for their mortgage-backed securities. And there would be, stringent limitations on their investment businesses, also sorts of like new products and things like that. It's sort of like, try to get them to focus on their core businesses of just guaranteeing pools of mortgages against default risk and accepting their guarantee fees. And so, there is this consensus, and there's also had been a consensus, I think, that wanted to keep these entities, as being sort of low risk entities. But of course, if you're going to recapitalize them and release them, private investors, they're not going to like low risk enterprises. I mean, I guess, some people will want to think about these things as public utilities. Investors are going to have other ideas and may not be as interested. So the Trump administration it has started to move to return the GSEs to the private sector, and this started a couple of years ago, mainly with a series of speeches that outlined some steps to move forward. The argument here is that the conservatorship was meant to be temporary. Remember that the stated purpose is to conserve the assets, to rehabilitate the institutions, and then return them to the private sector. But as I was sort of alluding to, this is going to require a balance between private and public interests. Again, investors, are going to want to have these charters, and they're going to want to get into everything and buy as much as they can get their hands on, and always push the boundaries of their charters. And I think taxpayers would like them to engage in a very narrow business and do it in not an especially risky way. So there are some initial steps for this. And so the first is for the FHFA to finalize new and higher capital requirements. And this actually happened last night. There was an announcement that they'd finalized the new capital requirements. They are much higher than previously faced. And in fact, I think the headline number in the press today was that, for their current book of business, they'd need $280 billion of capital. And they only have a fraction of that now. But finalizing a capital rule at whatever, the details are with it, but it provides management at the two companies with targets for earnings retention to get started. It'll also aid investor valuation of the firm's post-conservatorship. So this was an important first step to at least have a target on everybody's mind, so that then they can have conversations about what other sort of margins there are for adjustment. The next thing to do will be for Fannie and Freddie to provide their regulator with satisfactory capital restoration plans. So, each of them, I think together they have, say, I don't know, 50 billion in capital now. They need to get to 280. And so what a capital restoration plan says is, what is our path from going from the lower amount of capital to what we need, and the regulator defining its role during this transition period back to private control. The third thing that'll have to happen then is there should be a Treasury amendment to the preferred stock purchase agreements. Remember, they previously mandated a sweep of all the profits to the federal government. That clearly has to end, and they're going to have to be able to retain earnings. Now, what's interesting is the capital rule was finalized yesterday. FHFA is an independent regulator, so they can, there's not a huge time crunch on the first or the second. This third piece is very interesting because we're in this transition between administrations right now, and the Trump administration has been pretty busy the last week or so, making a lot of changes in various parts of government. And so people are sort of expecting that this amendment to the agreements with Fannie and Freddie is forthcoming. So in terms of subsequent steps, rebuilding through retained earnings could take an awful long time. And so it's expected that this will be sped up through a public offering. The Treasury did this with AIG in 2012 and Allied Bank in 2014. There are investor proposals out there. So one of them would basically extinguish the preferred shares that the Treasury holds now and argue that they've been fully paid back. I think taxpayers have received about $300 billion from Fannie and Freddie since these agreements were put into place. That the Treasury would then exercise the warrants for the GSE's common equity and then sell that equity to the public. The Trump administration believes that even outside of conservatorship, that Fannie and Freddie should have these very large backstops from the Treasury at $200 billion apiece. But really, even with that, we have to say, is there going to be sufficient interest to sell, $200 billion in equity into institutions where a lot of the rules of game are unsure and involve a lot of political actors. Oops. So I want to wrap up here. So, oops. The GSEs are hybrid public-private, or represent a hybrid public-private model of financial intermediation. These things are born of crises. Fannie Mae was created during the Great Depression, for example. They're inherently unstable. We've seen these things fail in the past and more recently, and they're never eliminated. They're always sort of repurposed to do new things. They are central today to our housing finance system, and that's been the case for 30, 35 years. They failed back in 2008, but once they were stabilized and redirected, they really aided in the housing recovery. Been a lot of changes to their operations since 2008. And the Trump administration has proposed this recap and release plan for Fannie and Freddie. The new capital rule came out yesterday. It's an important first step. What we don't know is what the Biden administration would like to do, how they would like to shape plans for their release, and ultimately how markets are going to view this. How excited are prospective equity investors going to be? How are debt and MBS investors react to them? coming out of conservatorship. So I know I probably ran a little bit long there, but I'll turn things back over to David and Wayne. And sorry for the technological problems.
It's okay, Scott. I think we were looking at your backup slides that you were working off. That they were fine, probably the same material. Let me ask a kind of just a big picture question, stepping back from all the technical details. But if you think about a lot of mortgage markets in other developed countries that have fairly well developed mortgage markets, they don't have a GSE kind of they don't have this federal backstop on loans. So what would we as consumers, do you think, see or notice if Freddie and Fannie cease to exist in any form? What's the downside?
Well, I think there is, I think you would see a move towards, it would affect the relative price of, say, adjustable rate versus fixed rate loans. I think you'd see on the margin, you'd see fixed rate mortgages become a little bit more expensive, perhaps. Although today for low risk loans, that jumbo conforming spread is actually negative. But it's possible you'd see some substitution. In the United States, we have, some people have claimed that, well, geez, the fixed rate mortgages would just vanish. I don't think that's true, because I think there's pretty strong, home buyers are used to these, are sort of ingrained in our culture. And I also think financial institutions, have learned over time how to manage the risks associated with them. These sort of interest rate risks that I was sort of alluding to earlier are not things that have been especially troublesome for investors, in the last 30 years, as we've had steadily declining and by historical standards, pretty low volatility in rates. But as you know, in the 1980s, they were all over the place, and all sorts of financial institutions blew up because of these things. The equilibrium I see, like in Canada, my understanding is that the typical mortgage is like a 5-year. I think it's like 5 years amortizing over 30, with a balloon at 5 years. Basically, you get refied. Other countries, I've spent a lot of time in Scandinavia. Denmark, actually, they've been changing a lot lately, but in a lot of other countries, Sweden, Norway, UK, Australia, they actually have like 1 month ARMs. I mean, they have hyper adjustable rate mortgages there, and that presents its own set of challenges. So as a central banker, this has been a big question as we buy a lot of mortgage-backed securities and try to provide some stimulus to housing. It's like, it takes a Herculean effort for us to move 30-year mortgage rates around. And our transmission mechanism is clunky and distorted. In Australia, all they have to do is move the overnight interest rate up 25 basis points, down 25 basis points, and there's like immediate stimulus or contraction in financial conditions. Something in between our system and theirs seems probably like a good equilibrium, because I think homeowners, I don't know what you guys think, but I mean, I think people like the idea of having some certainty about their mortgage payments for a period of time.
I think that's right. Well, I think we've got time for Edgy to ask his question. Go ahead, Edgy. Are you there? He's left us. His question.
He gave up.
His question was.
I was muted. Sorry.
There you go.
I was going to say, what effect do you think the high mortgage delinquency rate and the national rent moratorium will have on the secondary mortgage markets in the near future?
Kind of as a result of the COVID crisis.
Yeah. So, it's good, very good question. So, there was a lot of disruption in mortgage markets back in March. And, then there was the moratorium for federally backed loans, and that would include Fannie, Freddie, also the federal mortgage insurance program loans, like FHA and VA loans. The immediate effect was, people in the marketplace were like, well, especially mortgage servicers were sort of like, hey, listen, we understand there's this moratorium, but, I have to keep making payments to investors, even if the borrowers aren't paying me. And, in this sector of the market that's, securitized by Fannie, Freddie, Ginnie Mae, non-banks make up 2/3 of the market, and they don't necessarily have the same sort of liquidity that banks have. So we had a lot of conversations. So that was very disruptive and concerning. And I think the government put some things into place to help that. The Fannie and Freddie, along with the FHFA and HUD, I think they've tried to give guidance um, to lenders about how they're going to treat these kinds of loans. Overall, so I think there was this, to better answer your question, there was a lot of confusion and concern in late March and early April. Then I think that got sort of calmed down. And now the question, I think perhaps where you're going is, well, what happens when this moratorium ends in March? And I think for Fannie and Freddie's loans, they've seen the rates of loans and forbearance on their book of business steadily track down. I want to say the last time I looked, it was maybe 5% of their book. But they seem to be, as things reopened, things seem to be getting better there. The more concerning area is in the FHA portfolio, because I think their rates of forbearance have been stuck, and they've been stuck at about like 12%. And a lot of these, so my colleague Joe Tracy and I in Dallas, we put up, you might take a look at it. We recently put out a blog about this, but the profile of recent FHA borrowers has gotten riskier and riskier in terms of people having debt to income ratio, something like 25% of new loans in the government programs, the borrowers have debt to income ratios over 50%. And over half of the borrowers have debt to income ratios over 43%, which we normally think of as a high threshold. So these people that are like really on the edge in terms of managing their cash flows. And then, when you're talking about programs that really aim to serve first-time home buyers, but also especially disproportionately low and moderate income home buyers, people of color, who we all know have been disproportionately affected by COVID. I think we were estimating there's like $150 billion out there of loans that are probably in forbearance for FHA. And we think that could be a little tricky as we turn the corner into 2021, because these people, there's a lot of those people may still need some help, and maybe it's going to be through a big modification program or something. So that part remains to be seen, and it's a little concerning.
Thank you.
Just a little. Well, I think kind of bumped up against the time we like to finish. I'll thank you, Scott. I think we spend a lot of time in the MSRE program in various courses and discussions, case studies talking about real estate capital markets, but we tend not to focus on the home ownership side. And so I think you've given us a very interesting and detailed look at an extremely important sector of the capital markets that I think most of the students don't have a lot of exposure to. So thank you for that.
Yeah. Well, thank you guys very much for having me. It was a pleasure. Again, I maybe at some someday in the future, we'll be able to do this in person.
We'll look forward to having you in Gainesville, Scott. Thanks.
All right.
We're
Take
finished
care.
talking.
Have a good night.
All right.
Thanks, Scott.
Thank you.
You're welcome.